Well, you know the old saying, there's nothing for certain other than death and taxes. So that's the thing. That's the other side of investing too. You've had some success, you made some profit, and you don't get to keep all of it. You got to pay some in taxes, federal or local or state taxes on your gains that you've had in there. And we're going to talk here for a moment about taxes and understand it's not so much about what you make, it's about what you keep. So if you have some great gains, but you pay it all out in taxes or a large part of it, you may not be keeping it as much as a more tax advantage type of investment or mutual fund or whatever. But as we start this section, let's just get an understanding of how investing taxes kind of work, because it could be different or is different than, let's say, your regular salary or income that you might be getting, possibly. One thing with the tax section here, I'm going to give you some overall thoughts, overall ideas, but I'm very blessed to have students from over 141 different countries all over the world. So what does that mean? There's 141 different ways that people are taxed. So look at your own government and your own type of tax situation. So you need to do a little homework on that and do your own little research, and I'll give you some examples here to at least help you understand what to look for and some of the terminology you might be looking for, like capital gains, for example, terminology that'll help you when you're trying to figure out your own tax situation. So with investing, there's taxes and there's fees. That's part of the whole what you make or what you keep is more important than what you make. So that's where, like, on the fee part, just a side note on the fee part, that's why when you have mutual funds that charge high fees or a full service stockbroker that's charging high fees, you're not keeping as much of your investment. So things that you can do to drive the cost of fees down is going to really help you as far as what you overall keep, as far as what you keep, in addition to the tax bite you have as well. That's why funds like exchange traded funds or index funds are very popular. They give you a good diversification at very, very low cost. So those might be things to look at if you're finding you're paying a lot in fees. Now, but let's talk about taxes in this section. And as I said, taxes vary all over the world, so look at your own tax situation. But really, investing really breaks it down into two big buckets when it comes to taxes. The first one is capital appreciation. You may have heard me mention this a couple times in the course, but the first one is capital appreciation. That's the tax gain when you sell. And there might be other fees associated with it, like a transaction fee when you're buying and selling. So aware there's always fees, but when you think about capital appreciation, it's the taxable gain when you sell. So if I buy a stock at X and it grows up to Y, that difference between X and Y and its price and my value, my total number, like shares times the stock price, how much I made when I sell, that's a taxable gain. That's a tax event or a capital appreciation capital gain. So if you ever hear the terminology maybe where you live of capital gains or capital gains taxes, and they might be taxed at a different rate than your regular income type gain. At this current time in the United States, for example, there's a different rate on taxes, a better rate in taxes on capital gains than there is on your ordinary income or income you make on your, let's say, salary or your hourly rate that you're getting paid to work for somebody, for example. So think about the capital appreciation and what you sell it for versus what you bought it for. You might hear the term what you bought it for is your basis. So if you're looking at capital gains or reading stuff and they start talking about, well, you need to know your basis. Well, your basis is what you bought your stock at, your mutual fund or your stock at. That's what your basis is. That's where you started from. And hopefully it'll go up, but it could go down too. You're not paying taxes on things you're losing money on. Later we'll talk about tax harvesting as a strategy that will help you offset some of those gains. But for right now, you want to understand that you pay taxes on that difference between what you sell and what you buy it at. So it's important to keep records and know what you're buying your stocks at, because that's going to be your basis. Now, for a lot of things like mutual funds, for example, they're tracking that for you, or a lot of the online brokerages, and certainly a full-service financial planner, a full-service broker should be tracking your basis for you and including that in your reports. So when you're looking at the reports, or you get started with somebody, or if you're getting started, ask them, well, how do I know what my basis is? Do I have to keep the records, or do you keep them for me? If you're like my wife and I, especially my wife, the accountant, she likes to keep every single record. So if you do that, that's a great way to go. So that way you have the record of what you originally bought it for and not relying on others. But the firms should track it for you as well. So what happens is when you buy a stock, it's when you sell that stock is when you have a capital gain. Now with mutual funds, it's a little bit different because mutual funds are a basket of stocks. as an example, or bonds, whatever your mutual fund is, but let's say stocks, and they're continually buying and selling throughout the year. So then at the end of the year, they very likely could have a capital gain that they're going to pass on to you. So usually at the end of the year, maybe a month or so before the year ends, they'll send you a sheet and tell you what your capital gain is, and that's taxable income that you have. So if you have let's say a mutual fund that has a high turnover rate we talked about, or a high churning where they're buying and selling a lot, they might be incurring more taxes than something that's more tax efficient, like an index fund typically might be more tax efficient where they're not buying and selling as much, they're just kind of trying to match the index. So that's one way you have a taxable event, is a capital gain. The other way is through income or dividends. And that's when you get paid a dividend, or money is being paid to you directly from the company if you own an individual stock or a mutual fund or whatever. They'll pass those dividends through the fund and on to you. But let's think of it from an individual stock standpoint, that if I bought this individual stock and every quarter they're paying me a dividend, well, that's income that's coming into me. So you want to be aware that income is taxable. It might vary once again by country, but certainly in the United States, that income is certainly taxable. As an example, I would think it would be taxable anywhere. What you want to look at for your income from dividends is in your country to see if they might have a different way of treating income from dividends. Sometimes they might consider it like a short-term gain, same even with capital gains actually, a short-term gain that is taxed at a higher rate than a long-term gain if they separate it out that way. So understand it could be that way as far as your different stocks and different things as well. Typically, if you hold something over a year, you're going to be in a long-term gain category, but not necessarily. I mean, once again, it varies by country. A lot of times also, dividends are treated as ordinary income, or treated as just like your salary or hourly rate. And that might be at a higher rate than, let's say, a capital gains type of rate, for example. So in the U.S., you might be at a 20% capital gains tax rate, where your ordinary income, you might be paying 30% or more on that part as far as ordinary income. So see a tax advisor around that as far as the different types of tax situations for you. And understand you're still making money. It's just you got to pay out a portion of that money. So that's all good. Capital gains and dividends are good things. You're making money. Just understand you're not making all that money because there's still a tax hit there too. And those are the two primary ways where you see gains in your portfolio, but also where you see taxes occurring. And think about capital appreciation might be known as capital gains, and then dividends would also might be considered income. Okay, so we have tax consequences on capital gains or dividends. So what can we do about it? What are some things we can do? One thing you can do is to buy tax efficient funds or vehicles. Mentioned earlier, like mutual funds, for example, that have a high turnover rate, they're constantly buying and selling, is going to incur more taxes than a fund that might be selling less or buying and selling less. They're just trying to match an index, for example. That's one way they can be more tax efficient. There's also funds like mutual funds that advertise and promote that they're tax efficient mutual funds. Their whole thing is they're trying not to incur taxes or incur tax type things to try to get you your end overall gain to be a little bit better too. So if you're in a high tax bracket especially, and you're incurring lots of taxes, for example, from your investments, you might want to look at a tax efficient fund. Another consideration or way you can avoid taxes is to buy and hold, because taxes don't occur until you sell that item. Now, a mutual fund is different because that's where they're constantly buying and selling inside the mutual fund. You don't have much control over that. A tax advantaged mutual fund might try to limit it, but once again, you don't have control on that. You're at the mercy of the person managing that fund. Where if you buy your own individual stocks, once you buy that stock, that's your cash basis, you don't incur a tax on that individual stock until you sell. You might not sell that stock for 20, 30, 40 years. You might not ever sell that stock and pass that on to your heirs. And maybe there's some tax advantages in terms of estate planning or what happens when you die, as far as is there a tax advantage to your heir, maybe to avoid taxes depending on where in the world you live. So look at that as far as anybody who's involved with estate planning or your attorney with that. But the idea is I might buy and then I might not sell till many, many years. Until I sell, I'm not incurring a tax on a capital gain when I buy and hold. I'm not incurring that tax on the capital gain. Now, if I'm buying and holding a stock for 20, 30 years and it pays a dividend every quarter or pays a dividend every year, well, every year I'm going to pay taxes on that dividend that comes out every year. But I won't pay taxes on the overall gain until I sell the stock. If you have questions around that, just throw that in the question and answer area too, by the way. It can get a little confusing on that. But, once again, when I sell, that's when I have my capital gain tax. And then when I have dividends paying out, I pay tax on dividends, every year. Another thing you can look at is tax-advantaged accounts. And all over the world, they might have different tax-advantaged accounts. You might not have a tax-advantaged account where you live. I'm not sure. I've got 141 countries with great students from all those countries. I'll give you an example, though. I happen to be from the United States, so I can talk to that a little bit more specifically as an example. So in the United States, we have plans that are called like a 401k plan or a Roth IRA or IRAs. There's different things out there. Most popular are 401k and Roth IRAs. And the whole idea of that is you're taking income and you're putting a certain percentage of that into these tax advantage vehicles, so your gains grow without being taxed until later. Even you're not even incurring capital gains tax, you're not incurring even dividend tax while that's growing. It's in a tax advantage account. So that's a good place to put, especially income generating investments such as high dividend paying stocks, for example, because then you're not paying right away on that dividend, or bonds and things too, things that are paying out regular income type things. Put them in a 401k or a Roth IRA. You can have them outside too, but if they're outside a tax advantaged account, well, then you'll pay tax on it right away, and that's okay. Just be aware that's what's happening. But if you have something you want to defer the taxes on, you can use that with a 401k or Roth IRA. And these plans are a little bit different too, like a Roth. Once you make your investment, it could grow tax-free. Your gain is actually free, which is great, although Congress could change the laws anytime. 401k, it's basically deferred. You pay taxes when you take it out as a retirement or distribution. So think about tax advantage accounts. And then lastly, as a recommendation, have a variety of accounts. Particularly if you want to retire early, or you want to have that ability, that financial flexibility, because if all your money's in a tax advantage account and you can't touch it without a penalty until you maybe reach age 62 or 65 or 67, without a big penalty, like a 10% or more penalty, and it's all in that one spot, well, that might limit you if you want to retire at 59 or 55 or 45 maybe, whatever your goal is. So you want to have a variety of accounts would be my recommendation, especially around if you think that someday you might want to retire early. Weigh that versus the tax advantage accounts, of course, too, because of that deferral, but it doesn't hurt to have a variety of accounts. That's what I have. I have a variety of accounts, and I'm really glad I did, because now I have flexibility as far as my own, what I want to do with my life and what I want to do, so I have some flexibility with that. So that's something to think about too. And last thing under the tax considerations is unless you really high income or something where you really are getting killed on taxes or something, don't make investments solely based on the tax considerations. I mean, you might buy a poor, underperforming fund, but it's advertised itself as a tax advantage fund, and yeah, the taxes might be lower, but maybe you'd be better off buying that mutual fund that has such great results, and yeah, you pay a lot in taxes, but in the end, you're keeping more because the results are so much better, versus the fund that's not so good and you're not keeping, you made a little bit more as a percentage, but you're really not making overall more as far as a total because it's not as good a fund. As an example from a mutual fund thing. So, when you're investing, consider taxes, but don't let it drive your investment idea solely just based on taxes, unless you're, once again, getting really socked by taxes. And that's where you might be wanting to, spend a little money into like a tax account or a tax financial planner that can help you from an overall tax type of strategy. But really think about what's the best investment for you. But in the back of your mind, also consider the tax and fee thing considerations, but don't let it dominate totally, because you might be missing out on some terrific gains. One strategy that many people use in terms of taxes, and I use a lot myself, or whenever I can, is a harvesting your losses strategy. It's legal to do, and there's some rules around that, and we're going to talk about that. But it's a great strategy to use to offset the gains you might have and things that you might be paying taxes on. Now, with harvesting your losses, once again, whatever country you're from, look at it for your particular country. I'll give an example from the United States, but really just look at your country and talk to your tax folks about harvesting losses and how much you can and can't do and those types of things. So the idea of harvesting your losses strategy is it's a tax management strategy. It's not so much an investing strategy as in I'm picking out certain funds or something like that. There is an element of it. It's really about managing taxes. So think about harvesting your losses as far as managing taxes, reducing my taxes so I can keep more for me and my family, for example. you're using your investment losses to offset your gains. That's really the core part of harvesting your losses strategy. So if I sold some stocks or some mutual funds and I made this much in gains, but maybe I had a couple losers where I sold them at a loss. So maybe I had, to pick out some numbers, $10,000 in gains, and I had some things I sold that year that I ended up having $3,000 in losses. What I can do is apply those losses against my gain to reduce my taxable amount. So it's the gain minus the losses equals the net amount, and it's the net amount that I'm taxed on. Once again, it might vary by country, but certainly in the United States it works that way, and my understanding most places in the world too. So what it is, if I have that, for using dollars, excuse me for using dollars, but $7,000 in that gain, $3,000 in losses, I would then pay taxes on the net, or $4,000. So I will end up paying out less in taxes because I'm paying on a $4,000 gain versus versus let's say a $7,000 gain. So I'm using the losses to offset my gains. In the U.S., you actually have the ability that if you have no gains at all, you can each year take out $3,000 of your losses and apply that even against your ordinary income or your salary type income and reduce your taxes that way. So it's a great tool to use, that if you've got some winners and you've sold off some winners, or you're getting a lot of capital gains or things from mutual funds or things that might be happening, and if you've got some stocks or things you want to get out of and they're at a loss and you're selling them at a loss, well, use it to your advantage to at least reduce your taxable income because you're paying tax on the net. And that's the idea behind harvesting your losses. Now, a couple of do's and don'ts around harvesting your losses in terms of a strategy. And I found this little matrix from Fidelity. I've got the resource here right there for you, and it's really good. So I like it. So you can go there and look at it too if you want. Otherwise, it's right here. So, hats off to Fidelity, I guess. So in terms of do, you want to still follow your strategy. It's never a good idea to just do your whole strategy only based on taxes. You want to fit your overall investment strategy. So don't be selling something just to harvest a loss if you really think it's got a great upside and you want to hang on to it. So, don't just do that just for a simple tax thing. You might save a little taxes, but you might miss out on an overall gain. So it should fit your overall strategy. So that's first thing, and most important thing is whether you're buying or selling anything, that it fits your strategy and that you're researching it as far as your due on that side of it, that you're researching what's going on, you're researching these stocks, whether you're buying or selling, and as part of fitting your overall strategy, and that it's kind of working for you as far as the tax benefits of that. Particularly, one thing you want to research is your cost basis, because the idea is you're selling at a certain price, and it's the difference between what you bought it originally or your cost basis as far as what determines the gain. It's the same thing when determining your loss. Whatever you bought it for is your cost basis, and if you sell it down here or sell it at a loss, then that's going to be your difference is between the cost basis is your capital loss, or how much you can apply against that capital gain to reduce your taxes. So those are the two do's. A couple don'ts here as well. And one is the flip side of that whole do part, which is, don't undermine your overall philosophy or overall what you're trying to do just for a short-term tax advantage. I mean, it's not about that. It's about your overall investing. You might see some opportunities to harvest losses and offset gains, and you should take advantage of those opportunities, but don't let it be the focus of your whole strategy, because it might kind of mess up your whole strategy. You might sell off some potential winners. The other part is don't sell and buy things that are the same within 30 days. Now, this is specifically the United States, but I bet it's similar in other countries too. And it's called a wash rule, kind of like you're washing, right? It's it's a wash rule. You in the United States and other places, you can't buy, let's say, a stock or a mutual fund. Let's use, the S&P 500 index mutual fund, 500 largest companies in the United States. If I sell the Vanguard S&P 500 fund, and maybe I've had a loss on that, so I'm selling that because I had a loss, but then I take that money and immediately buy Charles Schwab's or Fidelity's 500 index fund, which is essentially the same, just different company. And if I do that within 30 days of selling this Vanguard, selling this, either 30 days prior to selling it or 30 days after I sold it, so kind of 60 days on either side, 30 days before, 30 days after. If I buy essentially the same stock or essentially the same, let's say, mutual fund or exchange trade fund, that's a violation. That's an illegal thing. You could get a penalty around that in terms of the IRS having or having your tax system as far as what's called the wash rule. And really what they're trying to do with that is they're trying to avoid manipulation, right? It's like, oh, I'll just have this 500 Vanguard fund, I'll just sell that, and I'll buy the identical thing, in Fidelity, and for my investment, I'm pretty much the same. I'd just be able to capture some losses that I can use against my gains. And the tax folks, they know that. The governments know that. So you can't do that as far as, like for like. Now I could say I could sell that Vanguard large capitalization company 500 fund and maybe get the Russell 3000 or Russell 2000 fund of index funds for small cap stocks, or I could buy a bond fund, or I could buy individual stocks. I just can't buy something that's very, very similar or like for like. So that's the thing you want to avoid in a wash sale. Now, after 30 days, I can then do whatever I want after that point, at least under the rules within the United States. So think about your own country, or think about the United States. Understand the wash rule aspect, and don't run afoul of that. If you got a question on that, just pop that in the question and answer area. But that's the idea as far as wash rules, that I can't buy something, the like for like, because I'm trying to manipulate things. So harvesting your tax losses is a perfectly good and a well-used and really a great strategy. You just have to understand some of the don'ts behind it, and really the two big don'ts are the wash rule thing. So you just have to make sure you're buying whatever you're buying new, or waiting to buy back in after 30 days. You could wait, put in cash, and then wait. And then really the last part of harvesting your losses is it's a small part of your overall investment strategy and ideas too. So and I can't emphasize that enough. That's part of your overall strategy. But if you can use it and use it in select situations, it can really reduce your taxes, which means you get to keep more money for yourself that you can invest or use with yourself or your family.